Hi, my name is Sean Durr with Lux Realty. I have the pleasure of having Stuart Epstein from CMG Home Loans. Thank you, Stuart, for coming.
Thank you, Sean. Thanks for having me.
I'm actually super excited to talk about this product of yours called the All-in-One Loan. I know that we talked a number of times, and I've already kind of done my research, done the number crunching, and I'm going to let you go and talk about it. But my biggest question at the end is going to be, how come everybody doesn't do this, especially with high interest rates that we're experiencing today? Obviously it works in any environment, and maybe people were ignoring it during the 3-4%, but in the 7-8% area that we happen to be in at this point, I think it's a extraordinary product. So tell me what this all-in-one loan does.
Sean, thank you. Thanks for teeing that up for me. I know you're excited about this product when you discovered it and you did your own due diligence with it. And it's really an amazing product that really doesn't exist out there on the market. The CMG engineered this product called the All-in-One Loan, and it's essentially a first lien line of credit. So it's a first mortgage. Okay, but it's not like your traditional mortgage. Your traditional mortgage that most people think about is a 30-year amortization. And when you see your amortization, you get depressed immediately because you see that your mortgage payments are all interest and very little principal.
Sure.
And when you get to year 28 and 29, it's mostly principal. The traditional mortgage is interest first. The all-in-one loan, first lien line of credit, think of it like the opposite. It's a principal first mortgage. The consumer's thinking, well, how's that work?
Yeah.
Why wouldn't everybody be doing that?
Sure.
Well, a lot of people should be doing it. Now, it's about getting the word out and educating people. Quite frankly, it's difficult to understand at first, but the math doesn't lie.
Right.
And we've got the tools. We can educate anybody on this product, right? Together, we can educate anybody on this product and show them the exact benefit.
Sure.
Without question. So you have a first lien line of credit.
Now let's just be clear, because when I talk to people, a lot of lenders and even builders that have loans, they often mistaken that any line of credit, or HELOC as we call it, is second, or if it's first, it's because they already purchased it. You're telling me that the all-in-one loan can be used to buy your home from the start.
When people hear the term HELOC, home equity line of credit, the inclination is to think, oh, it's a second mortgage.
Right.
Oh, I go get a home equity loan when if I've got equity built up in my home, I can go to the bank, I can open up a small home equity loan to pay for those home repairs.
Sure.
Or to help with funding, my kid's first year at college or whatever the case may be. But that's not the way a line of credit is dictated. That's just kind of how they've been traditionally used for the most part. They're smaller loans, they're second liens. This is a first lien line of credit that doesn't have the typical limits. One of the reasons why a lot of people don't look at a home equity loan as a first mortgage, one, the variable rate, which we'll get into a little bit, but also most home equity loans have caps at 250, maybe 300,000. Right. Our first lien line of credit, our all-in-one loan, has max in the millions.
Okay, so I can buy my mansion this way.
Absolutely. So that's not an issue. The other thing is we can do the all-in-one loan for a primary residence.
Okay.
We can do it for a second or vacation home.
Investment property.
And an investment property.
Wow.
There aren't very many home equity line products out there where you can do it on a second home or investment property.
Right.
Usually only for primary residence. Now here's the real beauty of this product and why it's principal first as opposed to interest first. This loan is actually tied to a checking account. So there's really two components to this all-in-one loan. You've got your line of credit, and then you got your checking account, which is a sweep account. Sweep account is where anytime you deposit money in that account at midnight, so this is a daily reoccurring thing, anytime you've deposited money in that account, at midnight it gets swept out of that account and pays down the principal balance on your line of credit. This happens automatically. You don't have to go in and transfer funds and all that. This happens automatically. Now, most people on the surface would say, well, if I have my paycheck direct deposited in this checking account and at midnight it all goes away, how do I pay my bills? Right? Another beautiful aspect of this loan is that you don't lose access to that equity. So basically what you're doing is you're taking your liquid assets. You're taking your positive cash flow, if you will, and you're using it to your advantage every single day by paying down principal. So the interest on this line of credit, as opposed to a 30-year standard mortgage, the interest is calculated on the principal balance daily. So your money's working for you every day.
So if I deposit my paychecks at the beginning of the month and lowers the balance, and then I had pay all my bills at the end of the month, I got those 3 weeks of having a lower interest payment being charged before my expenses, my home expenses come back out.
Absolutely.
And then, but then right after that, I deposit more money. So it keeps going down much faster.
Absolutely. The acceleration of principal pay down and the frequency of principal pay down is how you benefit from this loan.
Doing this with the sweep account where you're making your deposits and then paying out your expenses, in a sense, in a scenario, you're kind of like taking 3 steps forward with your deposits, 1 step back with your expenses, gaining 2 steps. And if you keep doing that every month, the ultimate result is going to be paying your mortgage off much, much faster. And I guess by what I've been seeing by using the simulator, I'm seeing anywhere between 7 to 10 years and we're done.
Absolutely. This product has been in existence with CMG now for almost 20 years.
Oh my gosh.
Our experience with it to date, we have a lot of experience over these 20 years of how is this loan performing for people. The average loan with the all-in-one gets paid off in less than 13 years.
Wow.
So the interest savings is staggering. If you look at your standard 30-year amortization, you know, when you see the amount of interest that you pay over 30 years, you may be buying that house essentially 2 or 3 times over.
Sure.
With the all-in-one loan, again, you're using positive cash flow to pay down your loan quicker. Now, can you accelerate a 30-year loan?
Sure, I can make extra payments.
You can just make extra principal payments.
Exactly.
So one of the questions we get, Sean, is, well, why wouldn't I just add principal to my mortgage payment? I can tell you from experience, folks typically have the intention of accelerating and paying down their mortgage quicker. One of the questions I get from almost all of the folks I pre-qualify, hey, is there a prepayment penalty on this loan? Because I want to add principal and pay it off quicker.
Right.
And the intention is there, right? Everybody wants to do that. Now, what do you think, Sean, is keeping somebody from taking, let's say they have a windfall and they have an extra 10 grand in their checking account, and their intention was, when I have this extra money, I'm going to dump it towards the principal and pay my loan off quicker. What do you think keeps people from doing that?
Well, my thought is that once you pay it, they can't get the money back.
Can't get it back, right?
No.
The intention, again, is always there. But one of the reasons why people typically don't do it is because they can't call up the mortgage company and say, you know what, mortgage servicer, I know I put that extra $10,000 towards my principal last month, but I changed my mind. I want to get that money back. That doesn't work.
I guess it's the same thing with a car loan. If I pay my car off,
right,
and then I realize that I shouldn't have because I need to set tires next month, and now I need that extra $1,000, I can't call back the auto loan. It's done. It's closed.
That's right.
The
You
only
have
way
to
I get
go
the
get
money-
another loan
or sell my car.
or sell your car.
Right? So I guess the whole idea of is making your money work harder and smarter, because anything that is sitting there in a checking account could be reducing your principal while not sacrificing your access to spend the money as you need on your expenses.
Absolutely. This loan turns into basically a cash flow tool
Right.
that you have in your arsenal that you can use. Financial advisors love this product.
Sure.
Financial advisors, from my experience, understand the product, they understand the math, and they love it for their clients.
The big question that, because we are all trained as consumers to shop the rate. But what we don't realize is that it's not necessarily, as you have demonstrated, that the rate is what's your enemy. It's the balance and the amount of time that you keep it. In fact, I ran your scenario many different ways, and I found that a lower rate, hypothetically 3%, if they're ever going to come back to that, but let's say hypothetically 3%, paid over 30 years, is more money spent than a 8% loan paid in 10 years.
Correct.
I mean, that's hard to swallow. I mean, because we all think I want 3%. So again, I know the math doesn't lie, and anyone that is interested in this should run this scenario with you and, pass it by their financial advisor. But my God, it's game changing. It should be in everybody's, list of things to do when they want to buy a home, to look at this all-in-one loan to see if they qualify.
100%. This may not be the right loan product for every single person.
Sure.
If somebody's on a fixed income, they literally have no additional, cash flow each month.
Mm-hmm.
It may not be the best product for them.
Sure.
Let's face it, it's not for everybody. But we have a simulator, which you've used many times for your clients to demonstrate the benefit and to show the actual interest savings, right? Based on an individual's financial characteristics, the deposits and expenses. If you know what they are and the frequency of them, we can literally plug those numbers into our simulator and it will tell you exactly how many dollars you're going to save in interest over the life of the loan, how long it's going to take you to pay that loan off. Meanwhile, you still have access to that equity.
Right.
Even if you pay it down to next to nothing, you still can tap that equity later on. Let's say you want to go buy the next home or you want to fund your kids' college education. You're not losing access. You never have to refinance. You don't have to go get a home equity loan. You already have one.
Right. Right.
Yeah, it's a beautiful product. It's something that we want to educate people more on, show them the value, show them the benefit. And I appreciate you helping me do that.
Right.
I really do.
Well, now is definitely the time that people should be looking at this with the interest rates where they are. I definitely can obviously say that every time I ran that scenario, the effective interest rate, if they follow the plan, is less than 5%. It's crazy. Sometimes I've seen it down to like 2. But again, it applies differently to everybody. So for all you buyers out there, if you want to overcome interest rates, it's simple math with an all-in-one loan. Again, thank you, Stuart.
Thank you, Sean.